Hey everybody, it's Larry Berman here. It just hit 4 o'clock on Friday. Let's dive into the chart room, see if we learned anything this week. A couple events coming up this week. Start to see some bigger earnings, but the Fed meeting. So Fed meeting's probably going to be a dud. If you look at the probability of the Fed moving on interest rates this week, it's basically zero, significantly. Not quite certainty that they trim another 25 basis points with 2.5 cuts in 2025 versus less than 2 in the US. So, argues weaker Canadian dollar from that perspective until maybe we get an election, until we had some certainty around, what may or may not happen in tariff land. So on the tariff notion, here's US election day. Here's the Dixie US dollar index. Again, about 70% weighted to Europe, UK exposure, a little bit of Japan sleeve, a little bit of Canada, and then a couple other really small currency exposures. So the Dixie's largely dollar euro as a major trade. US dollar, tariff man gets elected, US dollar rips higher. And as in the last week or two, Trump has softened his tariff narrative, that dollar strength has reversed. This move here on Friday was a little bit related to what he had said. Maybe tariffs aren't the way to go with China. I guess he had a call with President Xi this week, and who knows, maybe changed this tune, maybe setting the market up. I always believe that he's got some hedge fund there that he's leaking his leaks to, that are day trading his tweets and whatever else, but that's just me. So, I think as we get the new Treasury Secretary Scott Bessent appointed this week or confirmed this week, we get into the first quarterly refunding announcement, not this week, but early the following week. What the plan is for Treasury and funding some of this new debt, continuing debt. It's going to be a long time before, they're even able to make a dent in the dire fiscal outlet. When does the market matter? All those things are important. We did see the TLT long end of the Treasury curve bottom about a week and a half ago. 20-year auction was okay this week. We got this bounce up to resistance. It failed. Maybe it tries again this week in front of the Fed. It's going to depend a lot on what the Fed, will say and what Powell will talk about in his press conference. They've ignored the balance sheet runoff. Maybe that becomes an issue. Maybe it doesn't. But you can bet that President Trump is going to call Powell this week and give him his thoughts on what they should do for interest rates. Trump seems to be trying to get oil prices down so the Fed can cut rates, and that stimulates the stock market, and Trump can do a little bit of that and take credit for it. On the stock side of things, I'm a little bit surprised, not a lot, a little bit, that we were able to, so here's the last Fed meeting, right? Here's the Fed really being more hawkish. Equity shock correction. We gap filled the election night gap here. Talked about that in the last couple weeks. It held, reversal pattern, big covering move. Now, this is the setup for this week. Is this first day here, new high, marginal, fail back into the range, break to new high, but we ended up closing on a bit of an uptick above these highs, and so technically not a failure. Okay? An hour ago, it was looking like we failed back into the range. And so that's how fickle sometimes chart reading can be. And so we'll see what the future brings. But for me, for now, we would have to start closing below this gap here to really say that that's failed. It's a failed breakout. So we'll see this week. Fed, does the Fed, get more hawkish? Inflation data, the numbers since this meeting haven't given them a reason to be more hawkish, but it certainly hasn't given them a reason to be more dovish. So, neutral from the Fed this week, and we'll see how the market responds. But technically, if this gap gets closed and we start trading under it, would be a failed breakout. And as they say, there's nothing more bearish than a failed bullish pattern, and vice versa. There's nothing more bullish than a failed bearish pattern or a successful gap test reversal. So that's kind of what we're dealing with. I think you extend this out a few months. The best case scenario is probably some chop here, but a lot of animal spirits abound, and that just could drive us here. And frankly, it's very hard to read the tape right now. Anybody tells you they have insight into this on what's going to happen. Bulls be bulls. They're going to tell you the trend's higher, nothing to worry about. Bears be bears, and they're going to tell you, be cautionary. I've been known to fall into that camp only because I practice my as I preach as a risk manager, and by default, I'm a very cautious person. This week, I'm actually going to be in Miami. It's the Miami Alts Conference. For the last year, I've told people who are worried about the valuation in bonds and stocks that private credit and private equity in the next number of years are going to deliver mid to high single digits, low double digit types of return, and you just don't need to worry all that much about what's going on in the public side. And last year I moved all my risk assets into the private markets. Quite happy I did it. Obviously could have squeezed out a bit more on the public side, but I don't worry too much about this right now. I'm pretty confident I'm going to get a high single-digit return this year, next year, the year after. At some point, we're going to get a correction in the public markets. Valuations will come back to more reasonable. Probably needs a hard economic landing at this point. And as the data has come in, the jobs market is still pretty solid. Inflation isn't, spiking to the upside here. These things move, very, very slowly. And then, as they say, suddenly. So we'll see what happens here. This big low here that we made, really, really important. We start trading below that. We've got the 10%, 15% correction risk is on the table. Failed breakout here will be the first sign of that. But in order to get really bared up, you got to see that break. By the time that breaks, 6,100 down to 57 and change, you've already got a pretty significant, 5%er there. Anyways, lots of noise, lots to think about. I want to be really optimistic here and say the economy's going to have a pretty decent year, and therefore earnings are going to grow into what analysts think about and strategists think about. So if we look at earnings estimate and earnings growth, 10%, year ahead, 2 years ahead, $300 in earnings, 2026. That's what we're looking at here, and a 20 multiple is a 6,000 S&P, right? Like that's where we are right now. So theoretically, we could grow into it without a lot of, market growth. Which way is going to play out? You tell me how the economies go, and that's going to really define what happens here in markets. So far, so good. Policy mistakes is inflation. I think BlackRock came out with a thought this week that inflation was going to be stickier. Anyways, it's a good debate to have. Don't want to get too bared up here, but wow, there's a lot of risks in front of us here that markets just don't care about. Have a great week, everyone.